Imagine you're an investor. It's the peak of a massive technology boom. You find the company that makes the physical hardware required to run the new digital world. Every single tech company on the planet is practically begging this company for its product. The math seems foolproof. No matter which software company wins the race, they all have to buy their infrastructure from this one company. Naturally, Wall Street goes into a complete frenzy. The stock skyrockets by 1,000%, making it the most valuable company on the planet. But then, almost overnight, the music stops. The company's customers suddenly realize they bought way too much hardware. Demand drops to zero. The stock collapses by a brutal 80%, wiping out hundreds of billions in retail investor wealth. You're probably thinking, okay, I get it. You're talking about Nvidia, and you're saying the AI bubble is going to pop. Wrong. The company I just described was Cisco Systems, and the year was 2000. Cisco made the routers that allowed the internet to function. Investors assumed Cisco was completely bulletproof because everyone needs the internet. Yet when the dot-com bubble burst, Cisco shares imploded. The stock peaked in March of 2000. It took them 25 years to get back to that number. Now, I know the dot-com comparison gets thrown around constantly. Everywhere you look online, someone is overlaying two identical charts and warning that an AI crash is inevitable. But most of that conversation stops right there. Assuming that when the bubble pops, history will just replay itself exactly, and most tech stocks will vanish into thin air. The reality this time is completely different. If you're waiting for a carbon copy of the year 2000, you're looking in the wrong direction. As Mark Twain said, history doesn't repeat itself, but it does rhyme. And right now, the numbers are rhyming louder than ever. According to the Shiller PE ratio, which measures how much investors are willing to pay for every dollar of corporate profit, markets are currently at their second highest valuation in recorded history. The highest that number has ever been was $44 in December 1999, right before the dot-com bubble destroyed half the market. Except this time, the risk isn't hiding at the bottom with unprofitable startups. It's concentrated at the very top, which means when this bubble pops, it's going to happen in reverse. To understand what a reverse pop actually looks like, how it will impact the average person's portfolio, and how the most resilient investors in history navigated these exact cycles, we first have to look at what the underlying math actually looks like. Here's my best attempt at explaining it. Microsoft invested $13 billion into OpenAI. OpenAI then pays a massive chunk of that cash straight back to Microsoft to rent their Azure cloud compute. Microsoft buys hundreds of thousands of chips from Nvidia. Nvidia then turns around and invests $30 billion into OpenAI. But as part of the deal, OpenAI is obligated to buy a staggering $400 billion worth of Nvidia hardware. Meanwhile, Amazon steps in and invests $50 billion into OpenAI. OpenAI then strikes a $90 billion deal with AMD in exchange for a 10% stake in the company. A specialized cloud company called CoreWeave, partially owned by Nvidia, signs an $11.9 billion deal with OpenAI. In exchange, OpenAI is granted a $350 million stake in CoreWeave's upcoming IPO. Microsoft and Meta rent cloud capacity from CoreWeave, while CoreWeave also rents compute to Google and Anthropic. It gets even bigger. OpenAI, SoftBank, Oracle, and MGX partner up to build the historic $500 billion Stargate data center. To fuel this project, OpenAI signs a $300 billion cloud computing deal with Oracle. Oracle then takes that guaranteed future income and uses it to buy massive stockpiles of chips from Nvidia and AMD. And the loop doesn't stop there. Google invested $40 billion into Anthropic, while Anthropic committed to spend $200 billion on Google chips and cloud compute. Amazon also invested $8 billion into Anthropic, and Anthropic committed to spend $100 billion on Amazon Web Services. This is how convoluted the artificial intelligence sector has become. And these are only the deals we actually know about. Every single one of these tech giants is boasting to the media about record revenues, while the exact same bag of money just circles around the industry over and over again. In finance, this behavior is called vendor financing, and it is almost the same strategy that broke the stock market during the dot-com bubble. At their peak, Cisco didn't want their record growth to slow down, so they began financing their own buyers, loaning billions to small, unproven internet startups just so those startups could buy more hardware from Cisco. Cisco's revenue looked incredible on paper, right up until those startups failed to make money from actual customers, couldn't pay the loans back, and the entire ecosystem imploded overnight. Today, big tech is running the exact same play on a much larger scale. They've built a closed-loop financial feedback system where they pass the same money to each other to guarantee artificial demand. But a loop can only spin for so long before someone outside the circle has to actually pay for the product. This kind of irrationality isn't new. During the peak of the dot-com bubble, people completely abandoned old-fashioned metrics like profitability and proven business models. It was all about the dot-com stamp. Companies were going public without a finished product and still seeing massive success. Investors didn't care about cash cash flow. They just wanted a piece of the future, with stocks surging 400, 500, almost 700% on their very first day of trading. If a company simply added .com to its name, Wall Street treated it like a money printing machine. Fast forward 26 years, and the exact same psychological mania has taken over. Take Allbirds, for example. For years, a struggling wool sneaker company, but in a move that sounds like a financial meme, they rebranded as an artificial intelligence infrastructure firm called SmartBird. No data centers, no tech clients, zero AI revenue. The mere announcement of an AI pivot sent their stock exploding by nearly 600% in a single day. When shoe companies stop making shoes to buy microchips just to watch their valuations multiply overnight, you are not in a logical, data-driven market. You are in a casino. Which brings us to the ultimate question. If the structural foundations of this bubble are this fragile, how exactly does it fall apart? To understand that, you have to understand that while the psychological mania is the same as 2000, the underlying financial framework is almost completely different. During the dot-com crash, the financial risk lived at the very bottom of the pyramid. Thousands of tiny, unprofitable internet startups went public with no plan and no revenue, funded entirely by speculative debt. When investors realized these companies weren't making money, the funding dried up, and the startups went bankrupt first. Because they went under, they stopped buying hardware from the giants, and the collapse traveled up the chain to crush companies like Cisco and Compaq. But today, the risk is concentrated at the very top. The entities driving this trillion-dollar AI boom are not cash-strapped startups. They are the richest, most profitable monopolies in human history. They are funding these unprofitable AI experiments using the immense cash flows generated by their core legacy businesses. Because the top of the pyramid holds all the cash, the bubble cannot pop from the bottom up. The crash will start from the top. The moment our tech overlords realize that the billions they are spending on data centers and circular deals aren't translating into recurring profits from actual users, they aren't going to go bankrupt. They will just quietly close the checkbook. And when they do, the average person's portfolio gets caught in the middle. Microsoft, Apple, Nvidia, Alphabet, and Meta alone make up more than 30% of the entire S&P 500. Your index fund doesn't ask your permission before buying them. So when the AI hype fades and the hyperinflated valuations come back to earth, the whole index comes with them, dragging your portfolio and retirement accounts along for the ride. And the signs are already starting to show. The companies that rush to replace their human workforce with AI have slowly started to realize their AI replacements cost significantly more than the humans they replaced. These costs have become so impractical that Microsoft has explicitly stated they are moving away from Claude Code in favor of their own Copilot for employees. But if this much capital is being poured into AI, surely it's at least having a positive effect on the broader economy. Goldman Sachs decided to look into exactly that question.
A lot of the AI investment that we're seeing in the US adds to Taiwanese GDP, and it adds to Korean GDP, but not really that much to US GDP.
Can I just pause there for a moment? Because your point, and I think this is in the forecast as well, is that basically AI investment has been negligible to US GDP growth in 2025. Is that a fair assessment?
Okay. Yes, basically zero. Basically zero.
Huh. I wonder where we've seen that one before. So if nothing justifies these astronomical valuations and the hype train is visibly slowing down, surely this is the perfect time to short the market and profit from all these overinflated AI stocks. Absolutely not. This market may be highly irrational, but in the words of the economist John Maynard Keynes, markets can remain irrational longer than you can remain solvent. Almost everyone knows Michael Burry for predicting the 2008 housing crash, but what most people don't know is that he almost went bankrupt trying to time it. For years, his hedge fund Scion Capital bled millions in payments just to maintain his short positions. While the irrational market kept climbing, he was mathematically right. But he still only managed to survive by the skin of his teeth before the collapse finally hit. The exact same thing happened in the late 90s. By 1999, financial analysts were loudly predicting the end of the dot-com bubble based on undeniable math. Instead of crashing, the market literally doubled from that point, wiping out anyone brave enough to bet against it, before it finally came down in March of 2000. Trying to time the exact moment an irrational market collapses is a fool's game. The most resilient investors in history chose a completely different path: aggressive patience. During the absolute peak of both the dot-com bubble and the 2008 housing crisis, Warren Buffett was mocked by Wall Street, called past his prime out of touch, for refusing to buy overvalued tech and housing stocks. Instead, he quietly sat on mountains of cash. When the market inevitably corrected and the dust settled, Buffett was the one left standing. While everyone else was panic selling, he used his cash reserves to buy fundamentally strong companies at massive discounts. As of this year, Buffett is sitting on almost $400 billion in cash. Do what you will with that information. I'm not telling you how to invest your money. You should only listen to yourself when it comes to that. So when you go from buying when calls to working the register, you only have yourself to blame.